Okay, so I have to ask you a serious question right off the bat. A question that might just determine the trajectory of your entire Sunday and maybe your mood for the rest of the week. Have you have you opened your portfolio app in the last 24
Oh,
hours?
yeah, I have, and I regret it. That was a mistake.
See, that was your first error. If you were listening to this and you haven't looked yet, don't. Or, I don't know, maybe go pour yourself a very stiff drink first, maybe two. Seriously, keep the screen off unless you have a stomach of steel, because we aren't just looking at a red day, we are looking at a crime scene.
It is visceral out there.
Yeah.
That really is the only word for it. We are seeing a sea of red that, I mean, we haven't seen in quite some time. And it's not just the prices, it's the speed. The velocity of this move is what is keeping people up at night.
Visceral is a polite way of putting it. I'd say it's a bloodbath. Welcome to the deep dive, everyone. Today is Sunday, February 8th, 2026. If you're tuning in, you are likely wondering if the sky is actually falling or if this is just another, classic crypto bump in the road, where we panic on Sunday and buy Lambos on Tuesday. But let's look at the headline, because we can't ignore these numbers. Bitcoin hasn't just slipped, it hasn't just corrected, it has fallen off a cliff. We smashed through 80,000, we waved goodbye to 70,000, and this morning, we are touching lows near $60,000.
It's a significant move, a really significant move. And I think we need to frame this correctly right at the start. Often when people hear Bitcoin crash, they think of, I don't know, some 20-year-old day trader losing his lunch money on a meme coin. But we're talking about a liquidity crisis here. This is systemic.
Right, let's unpack that immediately, because I think a lot of people glaze over when they hear liquidity crisis. Why is this different from a standard dip? Why should the guy who only owns an S&P 500 index fund care that Bitcoin is down 30%?
Because of the spillover effect. This is the mechanics of modern markets. When you see a move this violent, I mean, dropping nearly 30% in a weekend, it triggers what we call cross-market de-risking. Imagine you are a big hedge fund. You have $1 billion in Bitcoin, $1 billion in gold, and $1 billion in tech stocks. Suddenly, your Bitcoin position gets absolutely hammered. You get a margin call. The bank calls you up and says, we need cash now or we liquidate you.
And you can't sell the Bitcoin because it's tanking and there are no buyers.
Exactly. Or you don't want to sell the Bitcoin at the absolute bottom. So what do? You sell what you can. You sell the Apple stock. You sell the gold. You sell the bonds. You liquidate the winners to pay for the losers. So yes, this crypto crash potentially hits your retirement account, even if you don't own a single Satoshi, because the big players are scrambling for liquidity.
That's the sell what you can, not what you want scenario. It's like selling your furniture to pay the mortgage because you lost your job.
That is a perfect analogy. And we are seeing that panic selling across the board. We are wading through the blood in the streets today to find out if there's actually an opportunity here or if we need to run for the hills.
And we have a packed stack of sources to get through to answer that question. We're going to talk about the return of the $0 theory. Yeah, that zombie is back from the dead, and it is hungrier than ever. We've got Michael Saylor facing a multi-billion-dollar paper loss that has people sweating bullets. Jim Cramer is taking a massive victory lap, which is annoying, but we have to listen to him because he actually got this one right. And we have a technical indicator that hasn't flashed this hard red since, wait for it, 2018.
That technical indicator is really the linchpin of our discussion later on. It tells a story that the scary headlines might be missing. It suggests that while the house is on fire, the fire department might just be around the corner.
Okay, so let's unpack this mess. Let's start with the crash report, as you've labeled it. Strictly looking at the numbers from our sources, how bad is the damage? Walk us through the timeline of this disaster.
It's been a brutal 72 hours. If you look at the price action from Friday into Saturday, we were already stumbling. We tumbled below $70,000, which was a key psychological support. That was bad. But Sunday morning, that was the capitulation.
Sunday mornings are usually quiet. That's when you drink coffee and read the paper.
Not in crypto. Sunday mornings are when the liquidity is thinnest. The banks are closed. The professional desks are offline. It's just the algorithms and the panicked retail traders. We crashed to a near 2-year low of roughly $60,000.
$60,000. It feels wild saying that because, a few weeks ago we were talking about $90,000, like it was the floor.
Yeah.
We were planning the road to 100K party. I think I even saw invites going out.
Yeah, the party has definitely been canceled. The caterers have gone home. But context is key here. We are down nearly 30% from the year-to-date highs. That is effectively a bear market compressed into a single weekend. In traditional stocks, a 30% drop takes 6 months. In crypto, it takes 6 hours.
And it's not just the price, right? It's the vibe. The vibe check is atrocious. I was looking at the sentiment data you sent over, and the fear sentiment has officially hit a 2026 high.
It has. Sentiment tracks social media volume, keyword usage, the tone of the conversation, and the chart looks like a heart monitor of someone having a panic attack. The fear metric is off the charts.
It feels like everyone just gave up at the same time.
The analogy I keep coming back to is a crowded theater.
Mm-hmm.
For the last year, everyone was watching the movie, enjoying the show, eating their popcorn. The movie was institutional adoption. Everyone was a genius. Suddenly someone yells, "Fire!" Now, nobody cares about the plot of the movie. Nobody cares about the fundamentals or the ETF inflows or the technology. The only thing that matters is the exit door.
And the problem with liquidity crises, as you mentioned, is that the exit door is only so wide.
Precisely. Everyone is trying to squeeze through a single door at the same time. The bids evaporate. You look to sell, and there is nobody standing there to buy from you. That is how you get these air pockets where the price just drops $2,000 or $3,000 in seconds.
And the sentiment data backed that up with the social media commentary, right? It's not just fear, it's despair.
Right. The ratio of positive to negative commentary is at its lowest point since November 21, 2025. The crowd has completely flipped. Last week it was buy the dip, and today it's over. It's totally binary thinking.
So here is where it gets really interesting for me. You and I have been analyzing markets for a long time. Usually when everyone is screaming fire and everyone is terrified, that's a signal.
It is. It is the hardest signal to act on, but it is often the most powerful.
That's usually when the selling exhaustion sets in.
That's the contrarian view. I mean, think about the mechanics of a trade. For every seller, there must be a buyer. But when the crowd leans too far one way, you run out of sellers. If everyone who wanted to sell has already sold in a panic, if all the weak hands have folded, who is left to drive the price down further?
Only the buyers are left, the diamond hands.
Theoretically, yes. The people who are holding for 10 years. But before we get too optimistic and start trying to catch falling knives, we have to address the narratives that are fueling this panic. Because they are heavy, and frankly, some of them are making a lot of sense to people right now.
Oh, they are heavy. And they are old school. We are seeing the return of the $0 zombie.
It never truly dies, does it?
It really is like the villain in a horror franchise. You know, you think you killed it, the credits roll, everyone relaxes, and then boom, Jason Voorhees pops up from the lake the second the price drops 20%. We're seeing a massive surge in the Bitcoin to zero theory.
And what's concerning this time is that it's coming from prominent voices. It's not just random Twitter trolls with AMA profile pictures yelling into the void. These are people with platforms.
Right. Let's look at Buck Sexton. He had posts that went absolutely viral this weekend. He said, and I'm quoting here because I want to get the tone right, "Every time I ask a Bitcoin true believer to explain, I come away more certain that Bitcoin has no long-term value."
Ouch. That stings because it attacks the core identity of the asset.
He's basically saying the emperor has no clothes. He's saying, I've listened to your pitch, I've seen your charts, and I still don't see a product. I see a Ponzi.
It's a sentiment that resonates powerfully when the price is crashing. It confirms the bias of the skeptics. When the price is going up, people ignore that argument. They say, well, the price is up, so clearly there is value. But when it's crashing, they look at that quote and say, see, I knew it. I told you it was magic internet money.
It validates the skepticism. And then you have Richard Farr from Pavotis Partners.
Oh, I saw this note. This was aggressive. This wasn't just a bearish note. This was an obituary.
His firm's target isn't just low. It is literally 0.0.
0.0.
That is harsh. That's not a valuation. That's an insult. What is his reasoning? Is he just hating? Or is there an actual structural argument there? Because to say something with $1 trillion market cap is going to zero, that implies a catastrophic failure of the whole mechanism.
He has an argument. It might be a flawed one, but it's coherent. First, he argues it has failed as a hedge against the dollar. He points out the high correlation to the NASDAQ, which, to be fair, has been true recently. If tech stocks dump, Bitcoin dumps. So he asks, where's the hedge? If I buy this to protect myself from the dollar collapsing, but it collapses with the dollar assets, what is the point?
That is a fair critique. If I buy insurance for my house, I don't want the insurance policy to catch fire when my house does.
Exactly. You want non-correlation.
Yep.
And his second point is about the miners. This is the death spiral theory. He points to miners bleeding cash. He says, the miners are the network, and they are bleeding.
Explain that mechanism for the listeners. Why do miners bleeding cash lead to zero?
So miners spend massive amounts of money on electricity and hardware to secure the network. They get paid in Bitcoin. If the price of Bitcoin drops below their cost of production, let's say it costs them $50,000 to mine a coin and the price is $40,000, they operate at a loss. If they operate at a loss for too long, they go bankrupt. They shut down the machines.
And if they shut down the machines?
The security of the network drops. Hash rate drops. If the network becomes less secure, people lose faith and sell. The price drops further, more miners go bankrupt. It's a feedback loop, a death spiral. That is Farr's argument.
It's a terrifying thought. And of course, we can't leave out Peter Schiff, the gold bug himself. I bet he's having a great weekend. He is probably popping a very expensive bottle of champagne.
He is feeling very validated. He's probably tweeting from a yacht somewhere. His argument is the classic utility debate. Gold is physical. It's used in electronics, jewelry, dentistry. It has a floor because it is a thing. You can hold it. If the world ends, you can, I don't know, melt it down and make a crown.
Or a really heavy doorstop.
Exactly. But he argues Bitcoin is purely belief.
Right.
It's just numbers on a screen. If that belief evaporates, the value evaporates. There's no physical floor.
Okay, I want to pause here and just debate this for a second, because this psychological impact is real. When you see your account down 30% and you read a guy in a suit telling you it's going to zero, that panic is visceral. But do people actually believe it goes to zero? Or is this just what we do when we're scared?
I think it's a crisis of confidence. When the price is going up, the belief feels like knowledge.
Yeah.
You think, I know this is the future. When the price collapses, that knowledge reveals itself to be just faith. And faith can be shaken.
Yeah.
However, we have to look at the history. We have heard the $0 narrative in 2018, in 2020, and 2022.
And every time it bounced back. Every single time.
And importantly, each time those drops happened, the infrastructure around Bitcoin was weaker than it is now. In 2018, you didn't have BlackRock. In 2020, you didn't have nation-states holding it on their balance sheets.
That's a great point. It's harder for something to go to zero when BlackRock and Fidelity have it on their books compared to when it was just, magic internet money on a USB drive. If Bitcoin goes to zero now, BlackRock has a very bad quarterly earnings call. Pension funds take a hit.
Precisely. The institutional entrenchment creates a different kind of floor. It's not a physical floor like gold, but it is a systemic floor. Too many big players are incentivized to keep the game going.
Right.
Speaking of big players who are incentivized, there is one institution that is currently causing a lot of heartburn.
Oh, boy.
And that is the whale in deep water. We have to talk about MicroStrategy, the Michael Saylor situation.
This is the drama on the weekend. This is Shakespearean.
It really is.
For the longest time, Saylor was the genius. He was the hero. He was the guy who bet the farm and won. He turned a boring software company into a Bitcoin treasury. But now, looking at these numbers, he is officially underwater.
And not just by a little bit. We need to look at the math here because it is staggering. MicroStrategy's cost basis, the average price they paid for all that Bitcoin, is estimated to be around $76,037.
Okay, hold on. I want to make sure the listener heard that. 76,000 is the break even, and we are sitting near 60,000.
Correct.
That is a massive gap. That is $16,000 per Bitcoin below what he paid.
And when you hold hundreds of thousands of Bitcoin, that math gets ugly fast. That means the unrealized gains that were in the billions a few weeks ago have evaporated. At the time of this report, they're sitting on a paper loss of roughly $630 million.
$630 million. That is a nasty number to report to shareholders. Imagine that board meeting. So, Michael, about that $500 million we lost this weekend?
It gives massive ammunition to the critics who argue that MicroStrategy isn't the floor for the price anymore. They are the anchor.
Explain that distinction for the listener. The difference between being a floor and an anchor.
Well, the bullish theory, the floor theory, was that Saylor would always buy the dip. If Bitcoin dropped, MicroStrategy would step in with their infinite money glitch, raise some debt, and buy it back up. They provided a safety net.
Right, the buyer of last resort.
But Peter Schiff's argument is that Saylor's buying is what caused the pump in the first place. It was artificial demand. Now that they are underwater, they can't buy as aggressively. Their stock price gets hit, which means they can't issue shares to buy Bitcoin. Their ability to raise convertible debt gets hit.
So the money spigot turns off.
Exactly. So instead of holding the market up, their sheer weight drags it down. Schiff says Strategy's buying caused the pump. Now their inability to buy causes the dump.
That makes sense. It's reflexivity. The way up is the same mechanism as the way down. If your leverage relies on the asset price going up, the moment it goes down, the leverage kills you. But Saylor isn't folding, is he? I saw his tweets. The man is defiant.
He is unwavering. He refuses to sell. He calls this volatility Satoshi's gift to the faithful.
Satoshi's gift. I'm sure the people getting margin called today are thrilling at the gift. Thanks for the gift. I lost my house.
I am sure they are sending thank you cards as we speak. Dear Satoshi, please stop giving me gifts. But Saylor used a really interesting analogy this weekend that I think is worth analyzing. He called his company the motor.
The motor.
Yes. He claims MicroStrategy is the motor powering the network to a multi-trillion-dollar asset class. He views his company not just as an investor, but as an active participant driving the value.
I kind of like that image, but there's a problem with it. If the motor stalls, the plane crashes.
Right. If the motor overheats and explodes, everyone goes down. But his point is about access and responsibility. He mentioned he has 15 million beneficiaries. These are shareholders, pension funds, people who own MSTR stock.
So he's saying, I'm doing this for the people.
He's arguing that he has integrated Bitcoin into the traditional financial system so deeply that he can't just disappear. He has a responsibility to these 15 million people to hold the line. He is digging the trenches. He's saying, I'm not locked in here with you, you're locked in here with me.
That is a bold strategy. He is betting that his conviction will outlast the market's panic. But the market doesn't seem to care about his bravado right now. The market is looking at the charts.
And speaking of charts and loud voices, we have to talk about Jim Cramer.
I knew we'd get here. Jim Cramer, the man we love to hate or hate to love.
He's taking a victory lap, isn't he?
A massive one. He's doing cartwheels. And honestly,
Yeah,
we have to give him this one. He made the call.
he did. We have to be fair. Cramer is questioning the bulls. He's asking, where are they? He notes that this flash crash below 80,000 proves his long-standing point. Bitcoin is unreliable as a currency.
He has a quote that I actually thought was pretty sharp. He said, no one ever seems to learn because we are all macro now, even if it is wrong all of the time.
That is a sting. But he's right. He's criticizing the idea that every retail trader thinks they are a macroeconomist. We all watch the Fed, we all watch the yields, we talk about liquidity injections, and we ignore the basic fact that the asset is incredibly volatile. Cramer warned that if Bitcoin didn't reclaim 77,000, which he called the launching pad, then the short sellers would pile on.
And look what happened. We failed 77, and the shorts piled on. He nailed the level. 77,000 was the line in the sand.
It was. But it gets worse than just Cramer. We have the Benjamin Button prediction. Have you seen this note from Stifel?
I have. And for our listeners, this is, well, it's a unique take. It's a bit of a brain twister. Stifel analysts are predicting a potential crash all the way down to $38,000.
$38,000.
That is terrifying. But explain the name. Why Benjamin Button? Are they saying Bitcoin is aging backwards? Is it turning into a baby?
In a way. Yeah. Think about the movie. Benjamin Button starts old and gets younger.
Yeah.
Stifel is arguing there is a reversal in Bitcoin's relationship with the dollar. Usually, the grown-up thesis is dollar weakens, Bitcoin strengthens. Bitcoin is the hedge against the dollar dying.
Right, that's the whole point. Digital gold.
But Stifel is seeing a decoupling. They argue that Bitcoin is losing its purchasing power relative to the dollar in a way that mimics a reversal of its life cycle. As the dollar gets stronger, which we will discuss with the Fed in a minute, Bitcoin is acting like a strictly risk-off asset. It's dropping with the bad news, not hedging against it.
Yeah.
It's acting immaturely. It's acting like a volatile tech stock from 1999, not like the mature asset we thought it was becoming.
So it's reverting to childhood. It's throwing a tantrum.
Exactly. It's a bit of a complex macro argument, but the headline number is what matters. 38K.
That would be a catastrophic drop from here. That would be another 50% haircut on top of the 30% we just took. That is pure capitulation. That's everyone go home, the experiment failed territory.
It is. It's the doomsday scenario. But before we all go jump out a window, there is a flip side to this. We talked about the fear index. Now let's talk about the jargon buster for the day. We need to talk about RSI.
Yes, the relative strength index. This is the hopium we need right now. Or maybe just the data we need.
It's not hopium, it's math.
Okay, let's unpack this for the listener who hears RSI and glosses over. What is it, simply?
Think of RSI like a rubber band. It measures the speed and change of price movements. It goes from 0 to 100. If it's high, like over 70, the rubber band is stretched to the top. It's overbought and might snap back down. If it's low, under 30, the rubber band is stretched to the bottom. It's oversold and usually snaps back up.
Simple enough. It measures tension. So where is the rubber band right now?
On February 6th, the RSI hit a historic low of 16.
16. You said usually under 30 is oversold. We're at roughly half of that.
It is extreme. This is the most oversold level we have seen since November 2018.
November 2018. That was the bottom of that cycle, wasn't it?
It was the absolute capitulation moment before the long grind sideways.
Huh.
It suggests that the selling has been so violent, so fast, that it is mathematically unsustainable without a bounce. The rubber band isn't just stretched, it's screaming. It's about to snap back and hit someone in the face.
And this is what Tom Lee from Fundstrat is looking at, right? He's the counterpunch to Cramer.
Exactly. Tom Lee thinks the bottom is in. He points to this rare time and price alignment. Basically, the RSI being this low combined with the fact that the market is clean of leverage.
Clean of leverage. What does he mean by that?
He means all the gamblers have been wiped out. The people borrowing money to buy Bitcoin, the ones we talked about earlier who are getting margin called, they are gone.
Yeah.
They have left the building. They have been liquidated.
The forest fire has burned all the dead wood.
Exactly. When the leverage is gone, the forced sell-in pressure stops. You have a clean market where only the holders, the people who actually own the asset outright, are left. Lee thinks this setup, extreme oversold conditions plus a washed-out market, is the perfect recipe for a V-shaped recovery.
So we have Stiefel saying 38K and Benjamin Button and Tom Lee saying the bottom is in and buy the V. Welcome to crypto, folks. Nobody knows anything, but everyone is sure of it.
That is the tagline of the industry. Strong opinions, loosely held.
All right, we are going to get into the macro picture and the Fed because, yes, the Fed is always in the room watching us, judging us. But first, we have to take a quick breather.
A mental reset.
Exactly. Listen, if you're finding this value and you want to survive this volatility without losing your shirt, make sure to comment and subscribe to Theta Fuse. We are tracking this every single day, so you don't have to stare at the charts until your eyes bleed.
And here's your favorite section. If you need a deep dive analysis on a specific stock symbol, maybe you're wondering if MSTR is a buy here or a trap, or maybe you're looking at Coinbase or even something totally different like NVIDIA, drop the symbol in the comments.
Yeah.
We'll pick the best ones to feature in our next deep dive. We love doing the listener requests.
We really do. Okay, let's get back to it. Segment 5, the macro headwinds. Because Bitcoin doesn't live in a vacuum. It lives in a world run by central bankers.
Unfortunately true. And we have a new variable in the equation, the Warsh effect.
Kevin Warsh. He's the nominee for Fed chair. Why is the market freaking out about him? I thought markets liked certainty.
They do, but Kevin Warsh represents a specific kind of certainty. He is a hard money guy.
Hard money. Sounds tough. Sounds unpleasant.
It means he doesn't like inflation, and more importantly, he doesn't like printing money. He advocates for higher real interest rates and a smaller Fed balance sheet.
So the era of money printer go burr is over.
If Warsh gets his way, yes. And that is a problem for speculative assets. Think about it. Bitcoin, historically, loves loose money. It loves when the Fed is printing cash because Bitcoin is the hedge against that debasement. It's the life raft when the dollar is flooding.
But if the Fed stops flooding the dollar,
If the Fed stops debasing the currency, if they make the dollar strong, and if they keep interest rates high, suddenly holding dollars isn't so bad. You can get a 5% yield on your cash, risk-free. Why hold a volatile asset like Bitcoin that can drop 30% in a weekend when you can get a guaranteed return on the dollar?
so Warsh is like kryptonite for the liquidity pump thesis.
He is certainly a headwind. He changes the macro environment from a tailwind to a stiff breeze in your face. He's taking away the punch bowl just as the party was getting started.
But is there any good news in the institutional plumbing? Are the big guys running away?
There is a glimmer, a slight glimmer of hope. Wajid Khan noted something interesting about the ETFs. Despite the price crashing, the ETF outflows are decelerating.
Decelerating. So people are still selling, but fewer people.
Exactly. The panic selling in the ETFs is slowing down. This implies that the institutional holders, the BlackRocks, the Fidelity clients, are not panic dumping en masse. They are holding better than the retail traders. Khan thinks this could provide the structural support we need to eventually reclaim 90,000.
Eventually is doing a lot of heavy lifting in that sentence.
It is. It feels very far away right now. But if the ETF flows turn positive while the price is this low, that is how bottoms are formed. It shows that the smart money is starting to accumulate while the dumb money is selling.
Okay, so let's recap the board. We've got the fear, we've got the zombie narratives, we've got Saylor underwater, we've got a hostile Fed, but we have a rubber band stretched to the breaking point. So what does this all mean? What do we do? It's time for the investment strategy of the day.
Let's focus. This strategy is for the traders who are looking at this carnage and seeing opportunity, not just risks.
We are calling this the rubber band snapback trade.
Catchy.
Yeah.
And appropriate.
So, lay it out. What is the setup?
The context is based strictly on that RSI hitting 16. That is a historic anomaly that screams oversold. But I want to be crystal clear. This is not a mortgage the house and buy forever signal. This is a setup for a short-term relief bounce.
Okay, so we aren't marrying this trade. We are dating it.
We are barely dating it. We are having coffee with it. The move is to look for a nibble entry near this $60,000 support zone. You're betting on a technical bounce simply because the selling has gone too far, too fast.
Okay, so buy near 60. Where are we getting out? Because that's where people mess up. They buy the bounce, but they don't sell.
You have to watch the levels Cramer talked about, 73,000 to 77,000. Cramer identified 77,000 as the resistance. If it bounces to 75 and it stalls, take your profits. Don't be greedy. The trend is still down. You are playing the bounce, not the reversal.
Got it. Buy the blood at 60, sell the relief at 75. But what about the person listening who is terrified? Who doesn't want to catch a falling knife? Who thinks Stiefel might be right about 38K?
For them, the strategy is patience. Wait. Let the fear wave cool. As sentiment noted, the traders posting doom and gloom today often become the rally chasers tomorrow. Let the dust settle. If the $0 narrative is wrong, Bitcoin will be here next week. You don't have to buy the exact bottom. It is safer to buy higher once the trend is confirmed than to buy lower and watch it go to Stiefel's 38,000.
That is wise advice. Sometimes the best trade is no trade.
Precisely. Cash is a position too.
All right, before anyone goes pressing buttons, we have to do the legal part.
Indeed. The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
There it is. Okay, let's wrap this up. Recap the chaos.
Bitcoin at $60,000 lows. Michael Saylor is underwater but refusing to fold. Jim Cramer is victorious for now. And the RSI is screaming that a bounce is imminent.
It is going to be a wild week. My final thought for you is this. Remember, volatility is the price of admission. If you want the gains, you have to stomach the drops. But for your own mental health, try not to check your phone every 5 minutes today. Go for a walk. Pet your dog. The market will do what the market will do.
Well said. Disconnect to reconnect.
Thanks for listening to the deep dive on Theta Fuse. We'll see you on the other side of the bounce.
Stay safe out there.